Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all listeners to the fourth session in the series of the videos on capital budgeting, where we are handling only the important questions from the exam point of view, December 2014. Before looking at this, I'm sure you would have looked at the three sessions before, wherein we talked about the payback period. In the second, we talked about the calculation of net present value, and then in the third one, we chose the mutually exclusive project, the best one out of those, using my net present value technique. So let's see what does this fourth session is holding us for. So moving to the fourth example, it says the two projects being considered by a firm are mutually exclusive and have the following projected cash flows. So at T0, which is the outflow, the project have -4 and X. So I think this is the value that we would need to find out. But let's just go through the question. It says that the project 1 will have 4, 3, 5 and 2. So there's outflow of 4 and these are the inflows. Total inflows are 10. In case of project 2, the outflow isn't given, but the inflows are given. So I think that's the part that we have to find out eventually. Let's just see what is the additional information. It says the crossover rate. Now this is a term which is very, very important, and we have learnt about that in the NPV profile, where the discount rate, the crossover rate, is 9%. So let's just dwell a bit and find out what is a crossover rate. The crossover rate is that particular discount rate at which NPV of two projects is same. So if I were to draw the graph, if this is the discount rate, the weighted average cost, and if this is the dollar amount NPV, then this is project A and this is project B. This particular rate at which the NPV are same is the crossover rate. So before 9%, project A is profitable. After 9% and up to this point, which is the IRR for project A, you have project B being better, and then after that eventually A has become unviable. It's only the B which needs to be selected, and eventually even the B has become unviable. So that's basically broadly the concept of your NPV profiles. So the question is, the crossover rate given to us is 9%. That means this is the rate at which the NPV of both the projects should be same. What we need to find out, the initial cash flows for project 2. So let me just plan that a bit. How do I arrive at that? So as a step 1, I will have to calculate the NPV of project 1 at 9%. Now whatever be this value, let us assume this value is, let's say, Z. Now Z will also be the NPV of project 2 at the rate of 9%, because it is the crossover rate, 9% being the crossover rate. Now using 9% and this NPV, I also know a formula that your PVCI will be equal to PVCO. So effectively this PVCI is a present value of these three cash flows, which will we find out at the rate of 9%, and this is what is we will calculate, and this is where we will come out here. So that's basically my planning for the question. Let's just start executing it. My step number 1, wherein I'm going to calculate the NPV of P1, which is a very, very simple exercise using my cash flow function. So my CF0 is -4, my CF1 with frequency of 1 is 3, CF2 is 5, and CF3 is 2. So obviously the assumption is, and this is a tacit assumption, that the cash flows happen at the end of the year, and using my beta 2 plus, my NPV is coming out to be 4.51. So this is like the NPV, a positive NPV of course, which I have been able to arrive for project 1. Now this again will be the NPV for project 2 as well, this being the crossover rate, 9 being the crossover rate, and PVCI is where I would just pitch in, drawing that on a timeline which is T1, T2, T3. The present value of only the inflows, which is PVCI, is coming out to be, again at the rate of 9%, is coming out to be 8.73. So let me just put this value here. It is 8.73 minus X. So if I do a very simple maths, 8.73 minus 4.51, it is 4.22. So this is my correct answer. Option C therefore becomes my correct answer. So to be very honest, in this question, the game, or should I say the entire plan, was to make this schedule and chart of activities what required. Calculations, obviously, at this level you are expected to be absolutely immaculate in doing these calculations. Should not be any error. There's no chances of doing that. So I think this is like the fourth session, and it's been pretty interesting one. A little complicated question of NPV profiles. Expect at least one or two questions out of that in the exam. This was Ankur Kulshrestha from Finstudyclub. Should you have any questions, query, doubt, you should please mail us at finstudyclub@gmail.com. You can also subscribe to our channel on YouTube, which is by the same name. So signing off for now. Looking forward to speak to you in my fifth session, which is going to be pretty much the last question on capital budgeting. So talk to you soon. Thank you very much.